So what is the Washington long-term care tax? So back in 2021, they announced that they're going to doing this tax to help people pay for long-term care coverages. Most people aren't buying insurance, and they fast forward to when they need the care, they don't have it. They blow through retirement expenses. They have to spend on all their assets to qualify for Medicaid, and it's just a mess. So this tax that they're charging you is for a benefit that you can get in the future should you need long-term care services. Now, it officially came out in 2023, and it's revamped a few times over the years. But really, when it comes to long-term care, when you get to a point or stage in your life when you can't do things that you normally could, so things like feeding yourself, transporting yourself, to run errands and things like that, being able to walk, transport yourself around the home, help with bathing, going to the bathroom, when your memory starts to slip, all those things are things that happen to everybody as they get older. Whether it's just purely old age, whether it's things like dementia or other forms of healthcare where you just can't do things like you used to. So that's when we consider it long-term care. Now, the default option a lot of people do is they rely on spouse or family to provide those services for them, but they're often aren't qualified caregivers, and more than likely, they're probably not the person you want to have caring for you in that time of need if you're trying to keep your dignity in check. They probably also have family lives of their own, and you might be disrupting it if you're relying on them to provide those services. So when you have long-term care insurance in this case, you're able to use it to pay for a qualified caregiver to come in and give you the care that you need. So the Washington state one is funded through taxes, through payroll taxes at 0.58%. That's currently the locked rate. Unless Congress, changes it, that's the way it's going to be. Now, there is no cap on it. So someone that makes $50,000 per year pays about $290 per year towards it. Someone that makes $250,000 a year pays $1,450. So the more you make, the more you pay. And yes, the high earners or people that work a long time can very well pay more into the system than they can ever get out. Currently, the benefit is capped at $36,000, and that started officially in July of 2026. It's like when someone could actually start claiming it. Now, that a rate will increase with inflation over time. Now, as far as the opt-out window, that window officially closed. So when this first came out, we were given a window of time where if you got your private long-term care insurance, you could opt out of it. That is no longer the case. Anyone new to working in Washington State, this tax is going to be permanent. There's no way out of it unless you are military, a spouse of military, if you're a veteran with over 70% disability benefits, or if you permanently reside outside Washington State. So you live in Idaho but work in Washington, you're considered exempt from this. Now, as far as the benefits goes, they actually got rid of the daily limit. So when this first came out, they relimited to like $100 a day payout, which $100 a day is only $3,000 a month. Most times, if you need help, depending on the level of help, it can be anywhere from $8,000 to $12,000, $15,000 per month. So the way it was originally written, you would only pay a partial bill, and it would still leave people short. Now they reworked it, so it does pay a lifetime benefit of $36,000 plus any inflation you get. So if that first month's bill is $10,000, they will pay that $10,000. The new wording is a little bit better. You should receive more money up front, and there'll be less waiting going on. Now, once that $36,000 is spent, done. Now you're on your own, and you have to fund it yourself, whether that's through your own private insurance, through your own bankroll, or you got to rely on family. As far as what it covers, any type of home health aid, adult family homes, assisted living, your nursing homes, caregiver training, modifying things in your home to make it more accessible, all considered supported claims under the Washington long-term care tax bill. As far as qualifying for this, the original version said you need to have 10 years to be vested, but we had a lot of people that were going to be working less than 10 years, pay into it, and get nothing out of it. So they did change it. It's now a 1-for-1. So every year you work, you get a 10% vesting window. To be fully vested, you do need 10 years, with 5 of those years being consecutive. So the new bill, it's a little bit more favorable, and paying even just a couple of years, you're still eligible for some of the benefits. It's not the whole thing. The next thing they updated was the portability. So originally it was for Washington State use only. You move states, you couldn't use anywhere else. Now there's potentially it can be portable. So it's not universal. You can't just go anywhere and expect to use it wholeheartedly. There are certain things you have to do or qualify to use it, but at least there is an option or a chance that you could use it even though you leave Washington State. So it's not going to be as flexible as your own private long-term care, but it's still a step in the right direction. If you're looking for the absolute coverage that will cover you no matter where you go. That's their case for getting your own private policy. Now, I should go without saying, but I'm going to say anyways because some people have asked, and is Washington long-term care tax or long-term care coverage enough for me? And chances are it's probably not. 36,000 isn't going to go very far at all. So if you're worried about long-term care or draining your assets, something like that, you want to make sure your kids or beneficiaries have some type of money to fall back on, and you don't blow it all in the last few years of your life in a nursing home, then it's probably a good idea to get separate coverage. Now, when you're buying coverage, remember you probably don't need to buy a giant policy because once you move into there, chances are all of your current monthly income is going to go towards that home. So if I move into assisted living facility and the bill is $8,000 per month, if I'm already getting, $2,000 from Social Security anyways, chances are my $2,000 from Social Security is going to go to offset that down. If I'm getting a pension of $2,000, that all that pension is going to go put that down. Right? I'm not only living at home anymore. I don't have to worry about the mortgage, the taxes, the insurance, all of that kind of stuff. So a lot of it will go towards that care. So if I know I have $4,000 a month fixed income coming in, moving to a place that costs, $7,000 or $8,000, now I'm only short $4,000. If I have any other assets I want to contribute, I could use that to cover it, or I just need to make sure I have $4,000 a month in benefits from a private policy. So when you're shopping around for long-term care coverage, you're not trying to foot the entire bill of the nursing home from it. All you're trying to do is piece it with what you currently have. This is where Washington State employees have a big advantage. Because you have higher fixed income than most people, your need for long-term care or the amount nearby is typically a lot less, which makes it more affordable. So as far as, should I get private long-term care? My opinion is always everyone should have some type of coverage in place. Because at the end of the day, if you look at the statistics, there's probably a good chance that you're going to use it. Even if it is just for a year or two, the cost of it can be catastrophic. Even if you are worth a couple $1,000,000, it wouldn't even put a dent in your pocket funding this yourself. I always look at it as why use my money when I can use somebody else's money. So if I know that there's a chance in the future that I could go to long-term care and it's going to cost whatever it is, $10,000 a month for 2 years, and I could put, $200,000 in an account somewhere and say, this is my long-term care pot. I'd be okay with spending it down, but why not just take 50,000 of that and buy the insurance? So when that $200,000 bill comes, I can use the insurance company's money and not just mine. That other $150,000 can be used to enjoy or give to beneficiaries, give to charities, and things like that. So being smart with your money is about leveraging it. And we always want to use other people's money, not our own. That's the whole point of insurance, right? It's the same way you probably bought your home is you probably didn't pay cash for it. You probably got a loan at some point. We use the bank's money to make it happen, and we paid it back over time. Same with long-term care insurance. We're going to be using an insurance company's money to pay for this coverage, and we're only going to pay a portion of it. So use the benefits that are available to you, and that's how you leverage and make the most use of your money and protect it all. All right, so in short, that's the update for the 2026 version of this Washington long-term care tax. It's tax that's here to stay. It's locked at 0.058%. You can't opt out anymore. And if you're wanting long-term care coverage, it's probably not going to be enough to support you overall. Now, if you're needing help structuring or getting a plan in place, it's something that we can always help you find a fit for. Now, again, if you haven't done so yet, you can join our free community over on School. The link is in the description below. I just released 2 new course videos teaching you how to build your own financial blueprint so you can have a better idea of where to get started and how to structure your own plans. Feel free to jump into that course and dive right into it. And always remember that your future depends on what you do today.